Markets looked calm this week, but under the surface, chaos. Keep watching. We'll unpack where quality quietly crushed volatility. If you're new here, I'm Berk. I've spent 40 years managing hundreds of millions of dollars for individuals, families, and institutions, and advising Fortune 500 CEOs and boards on shareholder value creation. I've seen every kind of market, booms, busts, and everything in between. This week, headline gains hid chaos underneath. The type of volatility that tests conviction. But it's also the kind that hands disciplined owners a gift. Today, we're going to unpack the key drivers that move the market, why our quality-first strategy outperformed, and keep watching, because we're going to get to our stocks and what they're signaling for the weeks ahead. Thank you for joining this week's market review for the week ending Saturday, October 18th, 2025. Our theme for today is navigating volatility with quality. As we'll see, this was a week where the headline gains masked significant underlying choppiness, making our quality-focused philosophy more critical than ever. At a glance, the U.S. equity market finished the week firmly in positive territory, marking its second consecutive week of gains. The S&P 500, or SPY, rose plus 1.7%. The tech-centric NASDAQ 100, or QQQ, was the standout, adding 2.5%, reinforcing enthusiasm for large-cap growth. We also saw strength in the small-cap Russell 2000, which gained 2.4%, suggesting a healthy broadening of market participation. I'm pleased to report that the value-aligned portfolio, or VAP, returned 2.0% for the week. However, the underlying story is that these gains masked significant day-to-day volatility. This was not a calm week. Trading was choppy as the market grappled with a host of conflicting signals. First, strong consumer data clashing with very weak manufacturing data. Second, renewed U.S.-China trade tensions. And third, a sudden flare-up of credit-related risks in the regional banking sector. That choppiness was clearly visible in the market's leadership, which was split. On one hand, we had a rate-sensitive rally. Real estate, or XLRE, was the week's top performer, rallying plus 3.3%. This was a direct response to the 10-year Treasury yield falling below the key 4% level for the first time since April. Lower yields reduce borrowing costs for these companies and make their high dividend yields more attractive. On the other hand, we saw continued secular growth strength. The technology sector advanced by 2.4%. This rally was fueled by ongoing enthusiasm for artificial intelligence, substantiated by an upbeat outlook from semiconductor leader ASML and major partnership news from AMD. Meanwhile, the financial sector was the worst performer, ending the week nearly flat at plus 0.04%. This was due to a sharp panic in regional bank stocks that dragged down the entire sector. Sharp, catalyst-driven moves in individual stocks also characterized this week's performance. This table reveals the market's specific anxieties and enthusiasms. JB Hunt, JBHT, surged plus 20.23%. This shows the market's reward for operational excellence, as the company reported stronger than expected results, driven by efficiency gains. American Express, AXP, rose plus 7.27%, hitting an all-time high after beating earnings estimates. This was boosted by strong spending from its affluent client base, a positive sign for high-end consumer health. On the downside, Hewlett-Packard Enterprise, HPE, sank negative 10%. The company issued 2026 guidance that fell significantly below expectations, citing a slowdown in enterprise IT spending. And Fifth Third, FitB, dropped, highlighting the market's sudden fear of idiosyncratic credit risk in regional banks. This was triggered by news from Zions and Western Alliance that raised concerns about borrower fraud and potential contagion. This brings me to one of the most important developments. The AI narrative is shifting from abstract potential to concrete business. This week provided hard evidence of the massive capital investment cycle we've been positioning for. First, ASML Holding reported robust Q3 results. Critically, 3.6 billion euros of its bookings were for its monopolistic EUV machines. The CEO pointed directly to continued positive momentum around investments in AI as a key driver. Second, Advanced Micro Devices, AMD, announced a landmark partnership with OpenAI. This deal, to deploy 6 gigawatts of its GPUs, is expected to generate tens of billions in revenue. And third, Broadcom's CEO confirmed the trend, noting their Q2 AI-related revenue grew an impressive 46% year-over-year to over $4.4 billion. This is no longer a potential story. This is a tangible capital investment cycle, and it is happening now. This AI strength is happening against a very conflicting economic backdrop. We're in a classic good news is bad news, and bad news is good news environment. The good news, which is bad for markets, the consumer remains resilient. We saw a persistent CPI inflation of 0.4% and a robust 0.6% rise in retail sales. This strength suggests the Federal Reserve may need to maintain its restrictive policy for longer. The bad news, which is good for markets, manufacturing and industrial data pointed to a slowdown. The Philadelphia Fed Manufacturing Index, for example, plummeted to negative 12.8. This weak data signals to the market that the Fed's policy is working, potentially bringing interest rate cuts sooner. This volatility highlights exactly why our philosophy is built on owning companies with growth drivers that are independent of this economic cycle. Adding to the domestic volatility were several global factors. US-China trade tensions. We saw a brief but sharp market sell-off triggered by posts from President Trump threatening 100% tariffs on Chinese goods. While the market recovered, it was a stark reminder of the headline-driven risk to global supply chains. European political stress. Leadership reshuffles in both France and the UK, driven by fiscal pressures, signaled potential market disruptions and headwinds for global growth. IMF Global Outlook. The IMF's latest report provided a sober assessment, projecting global growth will slow to 3.2% in 2025, with risks tilted to the downside. The critical insight here is the potential fading of US exceptionalism. As US growth converges with the rest of the world, it could lead to a weaker US dollar. This trend would directly benefit the US-based multinational corporations with resilient international revenue streams that we favor in the value-aligned portfolio. So, how did our philosophy perform amid this noise? The value-aligned portfolio delivered a strong week of absolute and relative performance. For the week, the portfolio returned plus 2%, outperforming the S&P 500's plus 1.7% gain. Year-to-date, the VAP is up plus 14.3%. Our concentrated positions in high-quality, secular growth companies drove this outperformance. LVMH was our top performer, surging plus 13.1%. This came after the luxury giant reported a significant rebound in demand from Chinese consumers, allaying fears of a protracted slump. ASML gained plus 10% following its strong earnings and a management commentary that directly highlighted positive momentum around investments in AI. And AMD climbed another plus 8.5%, after 30% last week, fueled by that major partnership with OpenAI. On the other hand, our holdings in Novo Nordisk and Eli Lilly were among our worst performers, falling negative 4.5% and negative 3.7% respectively. Our analysis is that fundamentals did not drive this. In fact, Lilly announced positive phase 3 data for 2 different drugs. The declines were a direct result of political noise. We view this as short-term noise impacting companies with immense long-term growth runways. Looking ahead, the week of October 20th marks a pivotal point in the Q3 earnings season. Key earnings. We'll be watching reports from Netflix on Tuesday, Tesla on Wednesday, and Intel and our own Kinsale Capital on Thursday. Tesla's report will be a key read-through on consumer demand, while Netflix will be a barometer for discretionary spending. Key economic data. We get China's Q3 GDP on Monday, and US flash PMIs and existing home sales on Thursday. This sets up 2 clear scenarios. The bull case. Strong earnings from bellwethers like Tesla and Netflix could validate current valuations. Also, weak data from China could increase pressure on Beijing for forceful stimulus, which global markets would view positively. The bear case. A significant earnings miss from a mega-cap leader could puncture the market's optimistic sentiment, or weaker than expected GDP from China could trigger a global risk-off move. This brings me to our final and most important point. This week's volatility, driven by conflicting data, political headlines, and credit fears, is precisely the kind of noise our framework is designed to filter out. Our goal is to execute a clear, repeatable process for long-term wealth creation. It consists of 4 simple steps. Filter out the noise. We recognize that daily data and political headlines create volatility, but rarely alter the long-term intrinsic value of a great business. Identify secular compounders. We search for high-quality businesses that can grow regardless of the economic cycle. Companies with durable moats, pricing power, and massive growth runways, like the AI build-out. Buy at a fair price. We use our disciplined value-aligned investing framework to determine a company's intrinsic value. We then wait patiently for the market to offer us a rational price, often during periods of maximum short-term pessimism, like the political noise hitting healthcare stocks this week. Hold for the long term. We believe true wealth is built through ownership, not speculation. We let the power of compounding work for us. The multiple column in our reports is the core of this philosophy. LVMH's 28.4 times multiple, ASML's 68.6 times multiple, or AMD's 408.9 times multiple since their IPOs are a powerful testament to the long-term wealth creation that comes from owning exceptional businesses. This week's outperformance was not an accident. It was the direct result of owning high-quality, secular winners that shone through the macroeconomic noise. You want wealth? Own great businesses. Everything else is noise. Subscribe, hit the bell, and share this with a friend who is still trading headlines. Want help applying this? Schedule a call. Links below. Stay the course.